paying for college is that you will often see what they might call best value colleges. And all of these colleges came up on one of these best value lists that I looked at. They're all great schools, but they're not best value colleges for everyone. So, for example, the military academy at West Point is free, which is great. That's a good value. But in return, your student will need to serve time in the Army, and the student will have to take the types of classes that are required at West Point. Berea College is a small college in Kentucky. It's fabulous. And almost everyone who goes to Berea is able to get a job that helps them to pay for college, and most people graduate debt-free. But unless you have extremely high financial need, you can't be admitted to Berea. Princeton is a great college with fabulous need-based aid, but if you don't have financial need, Princeton is going to expect you to pay as much as $85,000 or $90,000 a year. And the University of Illinois in Chicago is great if you happen to be an Illinois resident, and particularly if you live in the Chicago area. So all of these schools can be great for the right person, but the problem with these lists is that they really don't know anything about your student. And unless your student has a profile that matches the way these colleges set their prices, they may not be a good value for you. So we're going to talk about that today. Our agenda is going to involve two major topics: assessing where you might get aid, and then also deciding what you can afford. Assessing where you might get aid is a matter of understanding your student's profile in terms of potential eligibility for need-based aid and merit-based aid, and then understanding how colleges award aid. So if you have a profile that doesn't match the way the college awards aid, there's a good chance that you might be expected to pay quite a bit more than you expect. Deciding what you can afford is a matter of understanding the true total cost of college, and that's the net price of a four-year degree. You want to understand the resources you have available to pay for college, and that's savings and money that you can pay out of income. If that's enough, if that's not enough, you'll need to understand how much you might have to borrow, and then be able to make a decision about whether the amount of debt is reasonable. So we'll talk about all of that over the course of this morning. When most people think about the cost of college, they tend to think about the published sticker price, which is the kind of top line cost. So at SUNY Binghamton, it's about $29,000. At Wheaton College in Massachusetts, it's $75,000. Northwestern in Chicago is about $84,000, and NYU is about $80,000. But it turns out that all of these colleges award a significant amount of gift aid that helps to reduce the cost of college. And after gift aid, the average price that students who receive aid pay is about $20,000 at Binghamton, $33,000 at Wheaton, $22,000 at Northwestern, and $29,000 at NYU. But there's another wrinkle. Not everyone receives gift aid. So at Binghamton, 46% of the students are paying the full price. Only 54% are aided. At Northwestern, it's 50-50. Half of the students receive gift aid, half of the students pay the full price. And at NYU, 56% of the students are paying that full $80,000 a year. So when you factor in the people who are paying the full price, the true net price for all students at these schools is about $24,000 at Binghamton, $34,000 at Wheaton, $53,000 at Northwestern, and $58,000 at NYU. So the point of this is to remind you that it really doesn't matter what colleges charge. What matters is what you're going to pay. And what you're going to pay is your net price. That's the college's cost of attendance, or their starting cost, minus the amount of gift aid that your student might receive. So let's talk about the types of financial aid. I've been talking a lot about gift aid. That's free money, and that truly reduces the cost of college. Now, if that's based on financial reasons, that's typically called a grant, and that's need-based aid. If it's based on the student's academic background, grades, test scores, and so on, then it's typically called a scholarship, and that's merit-based aid. The other major type of financial aid is self-help. Now, this does not reduce the cost of college. It helps you to manage it. And the two kinds of self-help are work study, a job that the student gets typically on campus in the library or the cafeteria. And that's money that the student can earn during the academic year and use to pay for some college expenses. The other type of self-help is loans, money that you borrow to pay for the cost of college, but those need to be repaid after college with interest. So when you think about financial aid this way, it's pretty clear that gift aid is what you want to be focusing on. Unfortunately, colleges don't always make it clear what the gift aid is. So colleges will typically tell you how much financial aid you're going to get in what's called an award letter. And on this award letter, there are 7 items that total $22,000. Well, $22,000 is a lot of money, so that sounds great. But when you look at the items in more detail, it turns out that 4 of the lines on this award letter are gift aid, 2 of them are loans, and 1 of them is work study. So you need to take the subtotals of each of those different categories. And it turns out that the gift aid amounts to about $15,000, the loans are $5,500, and the work study in this case is about $1,800. Well, $15,000 is still pretty good, but it's not nearly as good as $22,000. And there's some important information that's missing, including the list price or the starting cost of this college, and then the true cost, the net price after subtracting gift aid from the starting cost. I went online and I looked it up, and for this college, for this student, the starting cost was just under $50,000. After subtracting $15,000 in gift aid, the net price for this student for 1 year at this college is $34,865. Now, keep that in mind. We're going to come back to that at the end. But first, I want to talk a little bit more about gift aid and how it works. So there are 2 types of gift aid. One of them is need-based aid or grants, and this is based on family income and assets. You apply for gift aid at all U.S. colleges using the FAFSA, and the FAFSA is also required for loans at all U.S. colleges. In addition to the FAFSA, there's a second application that's required for college-funded gift aid at about 140 colleges. And this additional application is called the CSS Profile. Now, there are over 2,000 colleges in America, so most of them don't require the CSS Profile. But the ones that do tend to be the most well-known colleges, and they tend to be the ones that are the most generous with need-based aid. So as your student is going through the college process, there's a good chance that you will have to fill out the CSS Profile. We're going to talk about both the FAFSA and the CSS Profile in a little bit more detail. The other type of gift aid is merit aid or scholarships, and these are typically based on grades, test scores, class rank, and although many colleges are now test optional, they're still using the information that they have available, primarily grades, to award merit aid. Now, merit aid is often awarded automatically with admission. So colleges will send a letter and say, congratulations, you've been admitted to our college, and we're going to give you a scholarship of $80,000, which is payable at a rate of $20,000 a year over the course of 4 years. But sometimes there are additional applications that are required. So you always want to make sure that you check the college's website and go to the financial aid pages to understand exactly what you need to do in order to qualify for as much financial aid as possible at that college. So let's talk in more detail about need-based aid. Here's the algebra portion of the presentation. Need equals COA minus EFC or SAI. I'm going to explain those terms in a minute, but the big thing that you need to remember is that need is the potential eligibility for aid. It's not the amount of aid that you're going to receive. It's the maximum amount of need-based aid that your student might receive based on the FAFSA or the CSS profile. So let's explain those terms. COA stands for cost of attendance. That's that starting price or sticker price of the college. And that always includes 4 elements: tuition and fees, room and board, so that's living in the dorm and a meal plan, books and supplies, and then transportation and other miscellaneous expenses. EFC stands for expected family contribution. And that's kind of a misleading term because it makes you think that that's what you're going to pay for college. In fact, most people don't pay the EFC. And as a result of that, the FAFSA has changed that term. And so EFC is now going to be known as SAI, which stands for Student Aid Index. So all the EFC or the SAI is a way of ranking all of the students who are applying to college based on the financial resources that the student and their parents have available. Now, college aid policies vary. This is really important. So some colleges have very generous need-based aid. They award full financial need. That's kind of a common term that you'll hear at some of the more well-known colleges. But other colleges don't award full need, and some of them don't award any need-based aid. If you want to estimate your EFC, you can go to this website. And by the way, I'm going to make these slides available to everyone at the end of the presentation. I'll be sending them to the Parents Association, and I'll put my email up at the end. And if you email me, I'll be happy to send you a copy of these slides. So if you go to this website, you can estimate your EFC. If you do estimate your EFC, that's going to be helpful, but it's not enough. So what do I mean by that? Let's say you go to that website and you estimate your EFC and it turns out to be 30,000. Well, that means you're going to have 0 eligibility for need-based aid at Binghamton because their starting cost at 29,000 is lower than your EFC. There's no financial need. On the other hand, if you apply to Columbia, where the starting cost is about 85,000, you might be eligible for as much as 55,000 in need-based aid. And if I can just remind people to please put themselves on mute, that will be better for the experience for all of the listeners. Another thing to keep in mind is that every college defines its idea of need, and the college's idea of need is rarely the same as the parents'. So we said that the EFC or the SAI determines eligibility for need-based aid. And by the way, I'm going to use the term EFC primarily during this presentation, but EFC and SAI are essentially mean the same thing. There are 2 formulas for determining the EFC. One is the FAFSA and one is the profile, but they both use the same basic approach, which is to look at the income and assets of the parents and the student. So there are actually 4 separate calculations that are going on in the background, and the subtotals from each of those calculations are added together to determine the total EFC. The most important component of this EFC formula for most people is the parent portion from income. Now, when they're talking about income, They always start with adjusted gross income from the tax return, and then they add certain items of income that are not included on the tax return, but are accounted for financial aid. Those are called untaxed income. Once you reach a relatively low level of income, every additional dollar of income adds almost 50 cents to the EFC. Parent assets, on the other hand, have a much lower impact dollar for dollar on the EFC. Once you reach a certain minimum level of assets, every additional dollar of assets adds about 5 or 5.5 cents to the EFC. They also look at the student income. That's usually not significant for most high school students, and student assets. Now, sometimes students do have assets in their name. And in that case, the impact on the EFC from student assets is significantly more than it is from parent assets. And here there's a loophole, and unlike most loopholes, ordinary people can take advantage of it. So if a student happens to have $10,000 in his or her name, that's going to add $2,000 to $2,500 to the EFC. If those student savings or investments are put into a student-owned 529 account, there's a special exception that values them as if they were owned by the parents. And so instead of adding $2,000 to $2,500 to the EFC, they would add about $500 to $564 to the EFC. So they're going to add up all four of those elements, and the total is going to be the EFC. A lower EFC means more eligibility for need-based aid. Many people think or wonder if they can make themselves eligible for more need-based aid by manipulating their income or assets to lower the EFC. In most cases, that's not going to be something that will be particularly fruitful. Most people aren't able to quit their job for 4 years during college. And even though it's potentially possible to move some assets in a way that might make them shielded from the EFC formula, many people find that doing so is really not in their best overall financial interest. And to have a significant impact, you've got to really move a significant amount of assets. So it often just really doesn't make sense. Now, there are a couple of special cases that we need to talk about in terms of need-based aid. When they look at the income, they're looking at income that was earned in the past. And in some cases, that past income may not reflect your current ability to pay for college. So for example, if there has been a death in the family, a divorce, a loss of a job, or some other type of economic hardship, then your current income may be less than the income that you're asked to report on the FAFSA or the CSS profile. In those cases, you want to contact each of the colleges that your student is applying to and ask for professional judgment to reevaluate your EFC. Now, colleges have the ability to do that, and they're required to at least consider your request, but it's up to them to determine if they're going to make an adjustment that might make you eligible for more need-based aid. The other special circumstance is when the parents are divorced or separated. And here, the FAFSA and the CSS profile have very different approaches. So the FAFSA is going to look at the custodial parent only, and if that parent has remarried, they will also look at the new spouse. Now, the custodial parent is defined as the parent who provides the majority of the student's financial support. The profile is going to look at both biological parents, and if those parents have remarried, they will also look at the new spouses. Now, so the profile may be looking at the income and assets of as many as 4 different parents and step-parents in determining eligibility for need-based aid. The profile does do some calculations in the background that are intended to put the primary burden for college on the biological parents. but those calculations are imperfect, and it often turns out to be a disadvantage for financial aid for the parents to have remarried. So remarry for love, don't remarry for financial aid. So we said that the FAFSA is looking at income that was earned in the past, and here's how the timing works. So for students who are seniors who are going to graduate in June, graduate from high school in June of 2024 and enter college in September of 2024, the FAFSA and the CSS profile are going to look at income that was earned in calendar year 2022. So that's the year that ended this past December. You filed your taxes in April. Your student is now applying to college for next year, and you'll be able to file the CSS profile anytime after October 1st. So the CSS profile is available for colleges that use that form. Normally, the FAFSA also becomes available October 1st of every year, but for this year only, it's going to be delayed. Congress passed some legislation in 2020 that made some major changes to the FAFSA, and the programming that's required by the Department of Education to implement those changes will not be complete until, well, they're saying December of this year. So I wouldn't count on the FAFSA being available until late December or early January. Assets are valued as of the date that you file the form. So you can file the CSS profile now. If you do, assets are valued as of now. If you file the FAFSA in January, then the assets will be valued as of January of 2024. Now, this potentially gives you a little bit of a planning opportunity. So if you have major expenses that you know you need to pay, it could be advantageous to pay those before you file the FAFSA or the CSS profile. The reason is that if you pay those expenses, they will no longer be in your savings or checking account, and so they will not be counted as an asset in the EFC formula. So I mentioned that there are some major changes coming to the FAFSA. It's not completely clear exactly what all of those changes and the impact of those will be. So I'm going to give you my best assessment as of now of what those changes are and their significant impacts. The key thing to keep in mind is that it takes effect for academic year 2024-2025. So it's going to impact seniors in the high school class of 2024 through all 4 years of their college. The EFC becomes the Student Aid Index. That's simply a change in terms. It does not change the math. The formula is changing, so there's going to be a different definition of income and assets and a new method for calculating the Student Aid Index. And I'll talk about that, some of those changes in a minute. Need is the same though. Before, cost of attendance minus EFC equals need. Now it's going to be cost of attendance minus SAI equals financial need. When you're entering income, most of the income items on the FAFSA are going to come directly from the IRS. That's going to make it easier for most people because you're not going to have to look up things. That income will be pulled in directly from your tax return. And in terms of the overall impact, the FAFSA changes are going to be beneficial for most students with high need. So there's going to be an automatic Pell Grant eligibility for people who are not required to file taxes or are within a certain amount of the federally defined poverty level. Now, when I say tax non-filers, I mean people who are not required by the IRS to file taxes, not people who just choose not to file taxes. So there will be significant expansion of the eligibility for Pell Grants. I've seen statistics that suggest that about 78% of students will have a lower SAI under the new rules and therefore higher eligibility for need-based aid. About 8% will have a higher student aid index and lower eligibility for need-based aid. And for the remaining students, it's going to be about the same. So what are some of these formula changes? Well, one of the most significant ones, and one of the reasons that I think accounts for the majority of the 8% of students who will have reduced eligibility, is that up until this year, there was a discount when there were multiple siblings enrolled in college at the same time. That discount for the FAFSA is being eliminated. And that could have some potential impact on families, particularly ones where they might already have an older student in college and a younger one now entering. If that's the case, you may want to appeal to have the aid reviewed, particularly if after you file the FAFSA, you see a significant change in eligibility. Another important change, untaxed income historically has included retirement contributions that are exempt from tax. But starting this year, the retirement contributions that are not reported directly on the 1040 are no longer going to be counted as untaxed income on the FAFSA. So for most people, those are 401k or 403b contributions. Gifts from relatives used to count as untaxed student income. So if a student had a grandparent who was helping to pay for college, that counted as untaxed income to the student. For the FAFSA, that's no longer going to be the case. Another change is that parent 529 accounts, which had the sibling as a beneficiary, used to be included as a parent asset. Those will no longer be included as a parent asset beginning this year. Businesses and farms, or small businesses and family farms, used to be exempt on the FAFSA. Now they're going to be included. And if the parents are divorced, the custodial parent is going to be the parent who contributed the greater portion of the student's living expenses. It used to be that the custodial parent was the parent that the student lived with the majority of the time. And that may often turn out to continue to be the parent who's providing the greater amount of the support. But if the non-custodial parent is making significant child support payments, that may no longer be the case. So those are the formula changes to the FAFSA. In addition, there are some changes in the way the actual process of filing the FAFSA takes place. So there's going to be a new parent wizard, which is going to guide students to determine if their parents are divorced, which is the custodial or contributing parent. Both the students and the parents are going to need an FSA ID to start the process. This is not a huge change because in the past, they needed an FSA ID to finish the FAFSA and sign it, but now you're going to need that FSA ID at the beginning. And the FSA ID is basically a set of login credentials, similar to what you might need at any website that you log into. It's really important, though, that you want to make sure that you keep a record of what those login credentials are, because you're going to need to use them throughout the years of college. If the student starts the FAFSA, the parent has to complete the FAFSA within 45 days or the record is going to be deleted. I think this is potentially going to be a problem for cases, especially where the parents may be divorced. Now, the student will be able to go in and start a new record, but it's going to be kind of disruptive if they've waited those 45 days and it's been deleted. And each party, both the student and the parents, are going to have to grant consent to a data exchange with the IRS. And that applies even to people who are not required to file income taxes. So that's something to keep in mind. For this year only, the FAFSA won't be available until late December or early January. And there's been there was a mistake when the law was drafted that implemented these changes. So in prior years, if a student were going for just one term instead of a full year, academic year, the FAFSA would be split between the various terms of the student's academic enrollment. There was a mistake, and that was not written into the law. And so if your student is offered, for example, spring admission instead of admission in the fall, you want to make sure that that doesn't negatively impact the FAFSA eligibility for need-based aid. So those are the changes to the FAFSA. A really important question is what's going to happen with the CSS profile. And the reason that that's so important is because the most generous need-based aid comes from colleges that use the CSS profile. At these CSS profile colleges, the maximum annual aid based on the FAFSA is about $7,000 to $10,000. But the maximum aid based on the profile could be as much as $70,000 a year or even more. Another reason it's important is because colleges that don't use the CSS profile often gap in their financial aid. What that means is they don't meet financial need, so there's a gap between the amount of need that the student has and the amount of aid that the college awards. So the profile is, the formula behind the profile is secret, but these are my educated guesses as to how the profile is going to react to these changes. I think the profile is going to conform to the FAFSA in which parent it decides is the custodial parent. That won't have that much practical impact because most profile colleges require that both the custodial and the non-custodial parent file the form reporting their respective income. I think that profile colleges will continue to count payments by relatives as untaxed income to the student. And so in those cases, the timing of when those payments are made could be important. I'll talk about that in a second. I think that most profile colleges will continue to count 401k and 403b contributions as untaxed income, even though they will not be included on the FAFSA. I think most profile colleges will continue to count sibling 529s as assets. Again, this is not how the FAFSA will work. And I do think that most profile colleges will retain a discount when there are multiple siblings in college at the same time. Now, historically, the profile discount has been less generous than the FAFSA discount, and I think in many cases it will be less generous. So you'll need to check with individual colleges to see if it will apply. So for seniors who are going to graduate this coming June, these are the years that are going to be counted on the FAFSA. So for the seniors' first year of college, beginning September 2024, they're going to look at income that was earned in 2022. For the second year, they'll look at 2021 income. The third year 2023 income. The third year will be 2024 income, and the final year will be 2025 income. Now, this potentially could be an opportunity for families who are fortunate enough to have a grandparent or another party who wants to help pay for college. Remember, I think that colleges that use the CSS profile are going to continue to count payments by relatives or parties other than the parents as untaxed income to the student. At those colleges, you may want to wait until after January 1st of the student's sophomore year of college. The reason is that the final year that's going to be considered for the FAFSA and the CSS profile will end in December of the student's sophomore year of college. So if you wait until after December for those grandparent payments to be made, the final income year will have passed, and those payments are less likely to have an impact on eligibility for need-based aid. Now, if your student isn't qualifying for need-based aid anyway, you don't need to worry about that. But if there's a possibility for need-based aid at a CSS profile college, that could be something you want to pay attention to. So these are the relevant dates for juniors, for sophomores, and for current ninth graders. So what we've been talking about so far is the student's profile in terms of eligibility for need-based aid. If the student does have eligibility for need-based aid, you may want to identify colleges that have generous need-based aid awarding policies. So how can you find colleges that meet financial need? Well, when colleges are awarding aid, there are three things they can do in terms of meeting financial need. One of them is to meet that need with a grant or gift aid. Another is to meet the need with loans or jobs. That's not as good as a grant. And the third way is not to meet the need at all, in other words, to gap the student, leave a gap between the amount of financial need and what the college awards. So you can go, and I use the College Board's Big Future website for this, to look up what portion of aid comes from grants. A higher amount is better. And you can look at whether there's a gap, and a lower gap is better. So if we look at Binghamton and the University of Maryland, you can see that they both meet 43% of need with gift aid or grant, and their gap amount is in the 30% range. So that's not the best in terms of need-based aid. Binghamton is still going to be affordable for most New York residents, but that's because of their lower starting cost, not because of generous need-based aid. At NYU and Ohio Wesleyan, the percent of need met with a grant is quite a bit higher, and the gap is lower, but there's still a pretty significant gap in those cases. At BU and Colby, the amount of aid met with gift aid is significantly higher. And in fact, Colby is kind of the gold standard of a college that meets full financial need, and almost all of it with gift aid. So they meet about 90%, 97% of need with a gift, and there's no gap at Colby. So if your student has high financial need, finding colleges like Colby is a great option if you're trying to find colleges that will meet that need. Now, Colby is a very selective college, so it's not a guarantee that the student will be admitted. And of course, that's another piece of the puzzle that you need to be thinking about. So let's say that you do have financial need. You want to understand whether need-based aid might make college affordable. So what I want to show you here is an example of a college with a very generous need-based aid policy, and how you can think about whether it might make their college cost affordable. So this example is a college that meets full financial need. The cost of attendance is $72,000 and the EFC is $30,000. So when you subtract 30,000 from 72, you see that there's $42,000 of financial need at this college. Well, this college is going to meet the first $4,500 of that need with a loan, the next $2,200 of need with work study, and any need that's left over, in this case about $35,000, will be met with gift aid. When you subtract the $35,000 in gift aid from the $72,000 starting cost, you can see that the true cost or the net price of this college is about $37,000. So the EFC was about $30,000, but the amount that this college expects the family to pay is $7,000 more than that, $37,000. And this pattern is going to continue through years 2, 3, and 4 at this college. So at the end of 4 years, there's been a cumulative EFC of 120,000, cumulative need of 168. The college has met the full 168,000 with aid, but not all of it has been gift aid. And so the total net price for this degree is 153,000. And remember, this is a really generous college, and this example doesn't include inflation. So the rule of thumb that I suggest you use is that if the EFC times 4 plus about $40,000 is not affordable, then need-based aid may not be the answer for you in terms of finding an affordable college. So if need-based aid won't make college affordable, maybe merit aid will. And to talk about merit aid, we need to talk about the business of college, because fundamentally, college is a business. They need to generate revenue in order to pay their expenses. Well, students and parents tend to think about the acceptance rate when they're thinking about colleges. The acceptance rate is the percent of students who are offered admission at a given college divided by the total number of students who have applied. So at Harvard, the admission rate is 3%, very low. At Northeastern and BU, it's a little under 20%. At Muhlenberg, Ohio Wesleyan, and Susquehanna, it's 70% or more. Well, colleges pay attention to the admission rate, of course, but they also pay close attention to what's called the yield rate. The yield rate is the percent of students who were offered admission at that college who end up enrolling at the college in the fall. So at Harvard, more than 4 out of 5 students who are offered admission end up enrolling. At BU and Northeastern, it's 30% or so. And at Muhlenberg, Ohio Wesleyan, and Susquehanna, it's a lot closer to 15% or even less. Now, when that yield rate gets into the 20s or lower, colleges really worry about whether they're going to have enough students making tuition payments to help them pay the bills. So what they do is they put themselves on sale. They discount their price with financial aid in order to compete with other colleges on yield. So the third column shows the percent of students who receive college-funded gift aid. It might be need-based aid or it might be merit aid, but the key thing is that they are getting a discount from the college's starting cost. And you can see that at Harvard and Wesleyan, it's 50% plus or minus. But at Muhlenberg, Ohio Wesleyan, and Susquehanna, it's in the high 90s or even 100%. So every student at Ohio Wesleyan is receiving some college-funded gift aid. The fourth column shows the percent of students who are receiving gift aid without having financial need. So that's an indication of merit aid. So let's talk a little bit more about merit aid. We said that the factors that typically go into it are things like high school GPA, class rank, test scores, the rigor of the curriculum, and so on. Now, merit aid used to be most prevalent at private colleges, but I'm finding that more and more public colleges use it too. And here's a key point. The highest awards go to the strongest students relative to the other students who are applying to that college. What that means is that you might get your highest merit offers at colleges you consider your safety schools for admission. So your safety schools for admission may also be your safety schools for financial aid. And college aid policies vary, ranging from colleges that award no merit aid, colleges like Harvard and Wesleyan, as we just saw, to colleges that use a very significant portion of merit aid in the way they set their prices with students. So I want to show you kind of a busy chart that gives you some examples of merit aid. Now, these come from before the pandemic, and the reason I wanted to use pre-pandemic statistics is because they have that was during the era when most colleges required test scores. And what you can see is that the higher amount of merit awards at these colleges is very closely aligned with the 75th percentile of applicants. The 75th percentile means that 25% of the students scored higher than whatever that SAT score was. So at Gettysburg College, for example, 25% of students scored higher than 1410 on their SAT, and the highest merit award at Gettysburg goes to students with a 1450, above that 75th percentile. And you can see that there's a similar correlation at the lower end of the merit scale. And so at Gettysburg, the lowest, or the 25th percentile, the point where 25% of the students scored lower than that was 1280, and and the lower merit award at Gettysburg was about 1300. So this is a pattern that you'll find is very common at colleges. So you can make a generalization from it. If a college uses merit aid, the best chances for the largest awards are when you're above the college's 75th percentile. If a college uses merit aid, the awards may phase out when you get to around the college's 25th percentile. But colleges that compete aggressively for students may award merit aid to everyone or nearly everyone that they offer admission to. So how can you identify colleges that award merit aid? Well, this is a great resource, College Navigator. And if you go to this website, this is where I get those percent of students receiving college-funded gift aid. At Gettysburg College in Pennsylvania, it's about 95%. And at Washington College in Maryland, it's 98%. So here's the rule of thumb that you can take away from this. When that percent of students receiving college-funded gift aid is over 65 or 70%, it's likely that the college uses merit aid as part of its awarding approach to financial aid. If it's over 80%, it's highly likely that the college uses merit aid. So where might your student get merit aid? Well, one way to check is to take a look at where the college's SAT scores are. SAT is still a pretty valuable measuring tool because it's pretty consistent from high school to high school and college to college. So US News and World Report reports SAT scores. And you can see that for a student who is an 1180 SAT might be looking at a college like Shenandoah University in Virginia as a place where that student might receive a generous merit award, because that student's 1180 SAT is solidly in the middle of the range of test scores at Shenandoah. And you can look for other colleges where the student is kind of in that range to get other ideas of where the student might qualify for merit aid. Another place you can look is what's called the Common Data Set. The Common Data Set is a very comprehensive set of statistics that colleges report to institutions like US News and the College Board. So if you Google the college name plus Common Data Set, you'll get these statistics. Now, I have to say they're not always the most user-friendly. So what you have to do is go to section 8 and then identify within section H, H2A and N and 0, N and O, I'm sorry. So this happens to be the common data set report for Hofstra University on Long Island. And at Hofstra, 372 of their first-year students received merit aid despite not having financial need. That's about a quarter of the students. And the average amount of merit aid was about $24,000. So if you subtract that from Hofstra's starting cost in the 70 to 75 range, you can see that if you get the average amount of merit aid there, your net price might be in the mid 50,000 range. So here are some examples of various colleges and their tendency to award merit aid. At BU, they award merit aid to only 5% of the students. So if your student is applying to BU, that's not the greatest candidate for a place that might award merit aid. On the other hand, Macalester and Dickinson, which are quite competitive small liberal arts colleges, not unlike Colby or Amherst, they award quite a bit of merit aid to students who don't have financial need. And Fordham and the College of Worcester award very significant amounts of merit aid. And you can see that bottom line, the percent of students receiving college-funded gift aid is only 47% at BU. It's close to 90% or more at these other colleges. If you look at public colleges, UC Berkeley is not a place to apply if you're from out of state and need financial need. They award very little merit aid, and they award very little need-based aid to out-of-state students. So if your student gets into Berkeley, you better plan on paying $70,000 or more. On the other hand, University of Maryland and University of Rhode Island do use some merit aid in the mix, so you might get some discount from their starting prices. And Arizona State and the University of Maine award a very significant amount of merit aid. So the big takeaway here is your best chances for merit are when a college has a relatively high admit rate, a relatively low yield rate, a relatively high percent of students who receive college-funded gift aid, and your student is a strong applicant relative to other students at that college. So this is a summary of how colleges award need and merit-based aid, and I've broken them down into 4 categories. I call them elite, near elite, mid-market, and other. Now, the elite and the near elite are colleges you've probably heard about: Stanford, Colby, Pitzer, Bowdoin. These colleges have very generous need-based aid programs. They tend to meet full financial need and a substantial portion of that with gift aid. On the other hand, they use little or no merit aid. There are maybe 100 or 125 colleges that fall into that category. There are about 2,000 colleges that fall into the mid-market and other category. Those colleges do not have as strong a need-based aid program, but they use a significant amount of merit aid. So there are colleges all over the country that are really dying to offer your student a discount in order to come. So we've been talking about defining your profile, identifying colleges. If you want to estimate your net price at these colleges, you can use a tool called a net price calculator. Now, net price calculators are required by law. Every college is required to have one, but they are not required to have good ones. And here's how you can tell if a net price calculator is good. If it has 5 or 6 questions, takes only a minute or so to finish, it probably stinks. If it has a lot of questions and kind of seems pretty tedious to fill out, it's probably asking for enough information to give you a better quality estimate. Now, don't be discouraged if you use one and you find it hard to use. You'll find that the types of questions that they ask are very similar, So as you use more and more net price calculators, you'll get better and better at it, and you'll find it takes less time. And remember, the net price is the cost of attendance minus the gift aid. Now, the new FAFSA rules also have some implications for how you're going to use net price calculators, because net price calculators are typically behind the times. They're usually a year or two old. So if you're using them, they may not reflect the new changes that are going to be implemented with the new FAFSA rules. If you're using a net price calculator, you want to first understand if that college uses the FAFSA only, or if they also use the CSS profile. If they use the FAFSA only, if your family happens to have multiple siblings in college at the same time, even if they do, say that there's only one in college, and that will give you a more accurate estimate. Don't include retirement contributions you made to a 401k or 403b plan. Be sure to enter the business value if you own a small business, and say that the business has more than 100 employees, because the exemption for businesses with fewer than 100 employees is being eliminated. And then don't include parent-owned 529 accounts which have a sibling as the beneficiary. If you're using a net price calculator at a profile college, enter the true number of siblings in college. Do enter 401k and 403b contributions as untaxed income. Include parent-owned 529 accounts with siblings as the beneficiaries. And if the student is going to be receiving help from a grandparent, that is going to be considered untaxed income for years that are covered by the profile. So once again, it may be advantageous to delay those until after the student's, after January 1st of the student's sophomore year of college. Now, when you use net price calculators, you're going to be able to compare the prices side by side and make an apples to apples comparison of the cost. Here's where I want to pause for a minute, because we've been talking about dollars and cents this morning, but there's more to going to college than dollars and cents. You also want to try to identify colleges where the student is going to be able to find the academic programs that he or she is interested in, where the student is going to have a social environment in which they can thrive. So the goal is not necessarily to find the cheapest college. The goal is to make sure that you find a college that your family can afford. And we'll talk about that affording question in just a minute. But when you do use net price calculators, you can compare the costs side by side. Here's an example of a student with a 15,000 EFC, B- to B grades, and an 1100 SAT. At Roger Williams in Rhode Island, the starting cost is $64,000. The net price calculator shows this student might get a merit aid offer of $14,000 and an additional $5,000 in need-based aid, and that results in a net price of $45,000. Shenandoah's net price is $38,000. Wheaton College in Massachusetts is $37,000. SUNY is likely about $23,000. Bowdoin College, with their fabulous need-based aid program, comes in at $17,000. That's only $2,000 more than the EFC. And Brooklyn College, living at home and commuting, has a net price of about $13,000. Now, a couple of things I want to say. I know that going to Brooklyn College and commuting from your parents' house is not the same as going away to college and living in the dorm. But the reason I include that example is because I want to remind everyone that there is an affordable path to college for everyone. And far better to compromise on where you go to college and graduate without having excessive debt than to go to a very expensive college and have unsustainable debt after college. The other thing to point out is that a B-minus student is probably not going to get into Bowdoin. So even though they have a great net price, it's probably not a realistic option for this family. So keep everything in mind when you're using these tools. All right, so we've talked about need-based aid, we've talked about merit aid, we've talked about net price and how to estimate yours. I want to finish up by talking about how to plan to pay for the net price. A key thing to remember is that the vast majority of gift aid comes from colleges themselves. So gift aid is already included in the net price. Scholarship aid from sources other than the colleges is very rare. So it's not wise to plan on that as a method to pay for college. The net price is going to be paid from income that you earn over time. So what do I mean by that? Well, there are three sources of income. One of them is prior income, income that was earned in the past and saved. One of them is current income, income that's earned by the parents or the students during the college years and used to pay for college expenses. And then the final source of income is future income, money that's earned after college and is used to repay the debt that was taken on to pay for college. So let's go back to that example we talked about at the beginning of the presentation where the net price was just under $35,000 and see if that's going to be affordable. We've got to remember that the cost of a degree is going to be for 4 years. And there are some important questions to ask. How much are costs going to increase over the course of college? And really important, is the aid automatically renewable and on what terms? If it is not crystal clear what's required to renew aid after the first year of college, make sure you go to the college and ask the financial aid and or the admission office what's required to renew aid each year. Need-based aid is typically renewable as long as the family's income and assets remain pretty consistent over the course of college. Merit aid is typically renewable as long as the student maintains a minimum GPA in college. But sometimes colleges do include aid that's only available for the first year. And if it's not renewable, that can be a problem when you get to paying for years 2, 3, and 4. For this example, we're going to assume that costs increase at 2% per year, that aid is renewable and constant over 4 years, and we're going to assume that the student has $2,000 in savings and the parents have $25,000 in savings available for college. So how do we pay for this degree? Well, when we extend the cost out over 4 years, that $35,000 for 1 year becomes $145,000 for the 4-year degree. I'm going to look first to the student. In this case, the college offered the student a work-study job with earnings of $1,800 per year, and the student can take out federal student loans as long as he or she files the FAFSA. There is a limit, though, to how much you can take in federal student loans. The limit is $5,500 for the first year of college, $6,500 for the second, and $75,000 each for years 3 and 4. Next, we're going to use the $2,000 in student savings. Remember, we said that student assets are assessed more heavily in the EFC formula. So if we use these assets first, maybe there might be a little bit more eligibility for need-based aid in years 2, 3, and 4. Next, we're going to assume that the student gets a summer job. And if the student gets a job that pays $10 an hour for 40 hours a week for 10 weeks in the summer, they'll earn $4,000. They'll pay taxes, go to the beach, but they can still save $2,000 or $2,500 for college. At this point, the student resources are exhausted, so we need to start looking to the parents. And these parents look at their income and they say, we think we can budget about $375 a month out of our ongoing income to pay for college. Well, 375 a month times 12 months in a year is $4,500 a year toward the cost of college. Next, we said that the parents have some savings, and if they use 19,000 of their savings, they'll fully pay for year one at college. In the second year, they're going to use the remaining 5,900 in savings. But at that point, both the student and the parent resources are exhausted. The only way to pay for additional cost of college is additional borrowing. And that I always consider a parent responsibility, because at a minimum, the parents are going to need to co-sign for any loans in excess of federal student loans. In this case, the parents need to borrow $15,000 to pay the balance of year two, $21,000 to pay for year three, and $22,000 to pay for year four. So at the end of 4 years of college, we've fully paid for the college using prior income, current income, and future income. It requires $27,000 in student debt and $58,000 in parent debt. Is that a good idea? We don't know yet. And to evaluate whether it's a good idea, we need to understand both what borrowing is going to cost and the resources that the family will have to pay that borrowing back. So what do federal loans cost? Well, student loans have about a 5% interest rate, or 5.5% interest rate. Parent loans have an 8% interest rate. They also have origination fees, and they're typically repaid beginning after graduation over the course of 10 years. Now, when you borrow money to pay for college, the interest clock starts ticking immediately, but you're not required to repay that interest until after college. So what happens is that the interest that accumulates during college is going to be added up and then added to the beginning balance of the loan when the loan goes into repayment. That's called capitalized interest, and the amount of capitalized interest per $1,000 of student debt is about $151. Per $1,000 of parent debt is about $221. So if the student borrows $27,000, about $3,900 of interest is going to be accumulated. The beginning balance of that loan is going to be about $30,900. The annual payment per $1,000 of student debt is $130. So that 30.9 thousand times 130 means that the student's annual payment is going to be about $4,023. The parent's annual payment is going to be over $10,000 a year. So that tells us how much the loans are going to cost. Is that a reasonable amount of debt to take on? Well, my rule of thumb is that payments for education debt should not exceed about 10% of the student's gross income. That leaves the student with about 90% of their income to pay for taxes, rent, and what I call the 3 Gs, gas, groceries, and good times. If the student borrows $27,000, those student payments are going to be about $4,000 a year. That means that the student needs to get a job that pays a little over $40,000 a year in order to have 90% of their income available for expenses other than education debt. And the good news is that for students, that's probably okay, because students on average, new college graduates on average, make about $40,000 to $50,000 per year. So that amount of debt is probably okay in return for the benefit that the student gets out of a college education. For parents, it's more complicated because they've got to consider their ongoing obligations, college for other children, and their retirement. And in this case, I see a big red flag. Remember when we were talking with the parents about what their budget from income was, they said they could afford $375 a month or $4,500 a year for college during the college years. So my question to them is going to be, if you can afford $4,500 a year during college, what makes you think all of a sudden after college you can afford over $10,000 per year? So this does not look like an affordable college for this family. Well, people talk about college all the time, and people often think, how does everyone else pay for college? Exactly the same way I have been describing to you this morning. So the cost of college is going to be the net price, the cost of attendance minus the gift aid. And over the course of 4 years, that will be the net price of a degree. The resources that you have available to pay the price need to somehow equal what that net price is. Now, I think that every student starts out with about $47,000 in resources. That's $10,000 in summer job earnings, $2,500 per summer. It's about $10,000 in work study, $2,500 per academic year, and that $27,000 in federal student loan eligibility. You start with that $47,000, add whatever the parents can contribute out of savings and income, and those are the resources that are available to pay for college. If those resources are not enough, then there needs to be either more parent debt or a lower net price. So when I work with families, I encourage them to think about what I call their zone of affordability. And to identify what your zone of affordability is, you can make a table that's 2 columns wide, one for the parents and one for the student, and 3 rows deep. And the rows are going to be savings, income, and debt. Now, as we said, the student automatically starts with about $47,000 in eligibility. Students typically don't have a lot of savings to bring to college expenses. So you need to look at the parents for any savings that are available for college and what the parents think they can pay from their ongoing income during the college years. I typically recommend that parents plan not to take out any parent debt to pay for college. So add up those 5 out of 6 squares, and those are the resources available to pay for college. The reason I don't like parents to take out debt is because most parents are going to be in their 50s or maybe even pushing 60 by the time their students graduate from college. If they have to pay debt for 10 years after that, they're going to be well into their 60s, and they're not going to have a lot of time to really focus on planning for retirement. Now, using tools like net price calculators, you can estimate the 4-year cost of a degree. You can match that to the resources that you've identified. And I recommend thinking about the point where the parents don't need to take on any debt as the highest price. That represents the highest point of your zone of affordability. So we've been talking about a lot of numbers, a lot of kind of heavy stuff. It's important to keep it in perspective. And I often think about it not unlike the stages of grief. And I would much rather have for parents to come to that acceptance point before their student goes to college, rather than after the student has gone to college and potentially taken on unsustainable debt. Another thing to keep in mind, and this may be a little surprising since I come from the perspective of promoting college, but college is important, but it's not the goal. The goal is to set the student up for success after college in a way that both the students and the parents are able to proceed with their lives and achieve their other financial and non-financial goals. Another way to keep it in perspective is to think about where some pretty successful people have gone to college. So Howard Schultz grew up in the Bronx. He somehow found Northern Michigan University and went on to build Starbucks into an incredible company. The head of Walt Disney went to Ithaca College in Ithaca, New York. The CEO of Hershey Foods went to Shippensburg University in Pennsylvania. And what do these schools have in common? They're all fine schools, but they are not the brand name colleges that people typically think about when they're thinking about college. And you don't need to go to a brand name college to have a good outcome. Another way to think about it is to think about the mid-career earnings. So the mid-career earnings at Boston for a graduate of Boston College are only $1,000 more than the mid-career earnings of a graduate of Loyola University in Baltimore, Maryland. But the net price over 4 years, the average net price at Boston College is $108,000 more than the net price at Loyola. So you're not getting a lot of additional earning potential for a lot more of additional college cost. So how can you find financial safeties for your student? Well, one way to do it is to use the numbers similar to what we've talked about this morning. Crunch those numbers and identify colleges whose aid awarding is likely to match the profile of your student. That's kind of tricky for some people, and there's kind of a shortcut way to do it, and that is to seed your list. In other words, to put colleges on the list that your student applies to that have a variety of ways of awarding aid. So for New York residents, a SUNY is almost always going to be affordable. You might think about an out-of-state public flagship. So UMass Amherst is about $55,000. But a secondary public college in Massachusetts, like Worcester State, is about $33,000, so over $20,000 a year less. If your student has high financial need, then you might want to think about a highly selective private college. If your student might need merit aid, the colleges that belong to the Colleges That Change Lives group, which you can access at this link, often use significant merit aid to attract students. And if the budget is really constrained, a commuter school like a CUNY or a local SUNY is always going to be affordable and potentially can save you thousands of dollars a year if the student lives at home. So I do work with families, and the Parents Association asked if I would be able to offer a discount in that case. I have a service that I call the Financial Aid Snapshot. It basically replicates the process that we've described this morning. And if anyone would be interested in that, I'll offer a $35 discount off that full price. And that's good for about 6 months through the end of April of 2024. So get in touch with me if that might be of interest. I have a website with some additional resources available. And if anyone would like a copy of the slides, I'd be happy to send them. I'll make them available to the Parents Association as well, but you can email me directly and I'll be happy to send a copy of the slides to you this coming week. So that's the end of the formal part of the presentation. Let's take a look in the chat and see if there are some questions, and I'll be happy to do my best to address them. I'm going to go back. There are quite a few points in the chat. So the net price, is that per year? So the net price typically is per year, but you always want to think about that total cost of a degree. So you can multiply the net price by 4 to get the estimate of what the net price for a degree is. You might want to multiply by a little bit more than 4. I usually use 4.1 or 4.12 to factor in inflation. Here's another good question. How much does one have to earn to qualify for need-based aid? And unfortunately, there's no easy way to answer that question because the formula for need-based aid is very complicated and it includes items in addition to income. I often see families whose income is in the mid six figures or mid 100 to 200,000 range who do qualify for need-based aid, but it may or may not be enough to make it sufficient. So that's why it's good to estimate the EFC. Here's a good question. What is counted as an asset? So the assets are always going to include cash, savings, and checking accounts. They'll include investment accounts like mutual funds and brokerage accounts. They will include investment real estate, so a second home or an investment property. They do not include retirement assets. So if you have an IRA or a 401k, the balance in those is not included as an asset. And home equity. Home equity is not an asset for the FAFSA, but it is counted as an asset for the CSS profile. And that can be a very significant point for people in New York where real estate costs are very, very high. So do they look at family total income? If one parent makes less income, could just that parent report it? Now, this is going to depend on if the parents are married or divorced. If they're married, both parents need to report. If they're divorced, they're going to look at the income of the parent that provides the larger portion of the student's expenses. Is work-study income considered earned income? Do I have to file taxes for it? I'm not a tax expert and I can't give tax advice. Work-study income is generally not included in income for the FAFSA and the CSS profile. I believe it will be included as income in a tax return, but that's something you'll want to double check with a tax advisor on. How does it work for single or unwed parents? Will they be considered custodial alone without the income and assets of the other parent? So that's a good question. If the other parent is living, then it's going to be treated similarly to the case of a divorced family. So they would look at the custodial parent only for the FAFSA. They'll look at both parents for the CSS profile. I have encountered some cases where a single parent has had, for example, a surrogate or a donor, and in those cases, they look at that parent as a single parent without looking toward another parent. So here's a good question. An apartment is under a trust name, and I've been designated as the trustee. Should I include the apartment as part of my assets? So if assets are owned in a trust, what's important is not who is the trustee, but who is the beneficiary. So beneficiaries are supposed to include the portion of the trust that they are the beneficiary of as an asset, but it would not be the trustee unless the trustee is also a beneficiary. A question about undocumented students without Social Security numbers. And this is a very tricky question. I'm going to recommend that anyone in an undocumented situation talk with the financial aid office at a local college. They are, in some cases, making it possible for undocumented parents and students to complete the FAFSA, but they may or may not be eligible for aid. And in some cases, this can be on a state basis. So if the parents or the students are undocumented, the best thing is to talk with a financial aid officer at a college that the student might consider. Most financial aid officers are sensitive to this, and you can ask anonymously, and they'll try to give you their best advice. Regarding stocks, how should the value be determined? Based on the current market price or the purchase price? It's going to be the market price. So any assets that you report are going to be based on their market value as of the date that you file the form. That applies to stocks, it applies to investments, it applies to real estate, and so on. Someone who filed a FAFSA several years in the past for an older sibling, the sibling or the student will get a new FSA ID for the student. If you had an FSA ID for the parent portion of the FAFSA, you should use that same FSA ID. Prior to the use of FSA IDs, the FAFSA used a PIN system. The PIN system is no longer in use. So if you had a PIN, you will not be using that. Instead, you'll set up a new FSA ID. But if you had an FSA ID for your older child, then you would use that for the younger one as well. Regent scores. That's really more of an admission question. It sometimes could be a factor in merit aid decisions. I think Regent classes are considered similar to honors classes in other states, but that's really more of an admissions question. Talking about 401k contributions, do you mean Roth or standard? So 401, and I think the question is wondering if they will be included as untaxed income. So retirement contributions and 401k contributions are included as untaxed income if they reduced adjusted gross income. So a standard 401k contribution would reduce adjusted gross income and would be included as untaxed income for the CSS profile. Roth 401k contributions do not reduce adjusted gross income. They would not be included as untaxed income. If the student is offered self-help, loans, or work study, can the student decline? The answer to that is yes. You are not required to take loans or work study. That's optional. And technically, you could decline grants, but no one's going to decline grants. There's a question about a sponsor of an immigrant, and this is really beyond the scope of what I can address this morning. The financial aid process and systems that I've described are really primarily for US citizens and green card holders. So for questions about sponsors, immigrants, undocumented, you would need to speak with either a financial aid office or a lawyer who specializes in that. When does the FAFSA need to be submitted? So in general, it's a good idea to submit both the FAFSA and the CSS profile at about the same time that the student is applying for admission. This year only, the FAFSA won't be available until January, and it's possible, or late December or January. It's possible the student will file for admission before that. So what you want to do is to file the FAFSA as soon as possible after it becomes available. And the reason for that is so that the college can confirm the amount of financial aid, and that way you'll have a firm idea of what the cost is. In some cases, people file the FAFSA only for loans. Sometimes they decide that they don't think they're going to qualify for need-based aid and do want to try to get loans. In those cases, you can wait until after the May 1st college decision deadline and file the FAFSA solely to get loans. But you'll want to do it in time for the college to process it and apply the loan to the bill. Is credit card debt considered when applying for aid? The answer is no. Most debt is not considered in the financial aid formulas. The only debt that is automatically considered is debt that directly secures an asset that has to be reported on the form. So, for example, a home mortgage would be considered at a CSS profile college where you're required to report home equity. It would not be a factor on the FAFSA. The other types of debt that might be included might be debt on a second property, investment real estate, or if you have margin debt on a brokerage account. But unsecured debt is generally not counted. That includes education debt. However, education debt, you can sometimes appeal for education debt by either the parent or the student to be considered, but that you would do by emailing the college on a case-by-case basis. Can you exclude some information when filing the FAFSA so your earnings don't seem as high? The answer is not if you want to do it legally. You are signing and attesting that the information that you provide on the FAFSA is complete and correct. And college financial aid officers are quite experienced at identifying FAFSAs that seem inconsistent. So I think it's unwise to not be truthful on the FAFSA. We're divorced and have a joint custody agreement. How does that impact financial aid? Well, we've talked about divorced situations and the custodial parent being the parent who provides the greater portion of the student's support. That's independent of any agreement that might have been made at the time that the divorce was finalized. So the financial aid rules for divorce are not the same as what the judge may have determined. So it's going to be that parent that provided the greater portion of the student's expenses. If parents are divorced and one of them is totally not involved, pays the minimum needed but does not participate, how will it be counted for the FAFSA and the profile? Well, in that case, it's likely for the FAFSA that the parent that the student lives with is providing the greater amount of support. And in that case, that parent would fill out the FAFSA and the other parent would not be included. For the CSS profile, they ordinarily expect that both parents will participate by completing the form. If the other parent refuses or is unable or is out of the picture, you can apply for a waiver of the requirement for the non-custodial parent to participate. And then colleges will decide on a case-by-case basis if they will accept that waiver. ED1 only counts the CSS. Will the college adjust the SAI after the FAFSA? So ED1 is early decision. And early decision, let me just make sure everyone understands, early decision is a way of applying for admission in which the student says, if I apply to your college and you offer me admission and you offer me enough financial aid for it to be affordable, then I commit to going to your college and will withdraw my applications from other colleges. Early decision is sometimes an advantage for admission. It's often a disadvantage for financial aid because you won't have the ability to compare financial aid offers from other colleges. Sometimes when you compare offers, if you get a better one from another college that the college considers a peer, you might be able to use that as a way to get an additional aid offer. For colleges this year, when the FAFSA is not going to be available until late, I believe that most colleges that use the CSS profile will make their aid award based on the CSS profile information only. The CSS profile includes all of the information that's later going to be required on the FAFSA. So I think they were likely to honor the award they make based on the CSS profile. The only exception to that would be if the FAFSA comes in later and in some ways offers additional information that conflicts with the information that was on the CSS profile. In that case, they'll want to make sure they understand that was there a mistake made. When should we apply for the FAFSA, now or in December? Well, if you apply for the FAFSA now, you're going to be using the FAFSA that was in effect for the prior academic year. So it's not prohibited from doing that, but it's not going to help you. So you'll need to file the FAFSA for the coming academic year when it becomes available. And because of the major changes in the law, that's not going to be until late December or maybe even January. So here's a question. I'm a junior right now in high school. When should we sign up for the FAFSA and such? The answer is going to be during the fall of your senior year. So you will not file it. You will not sign up for the FAFSA now. You'll wait until next year when you're ready to apply to colleges. Here's an interesting question. In terms of the admission decision, does it change the student's desirability for more selective colleges if we apply for FAFSA loans only and choose to wait for May versus immediately applying? So what this person is getting at is what's called need-aware admissions. At a few colleges with generous need-based aid policies, their budget is not enough to offer full financial need to all of the students who might need it. And so what that means is they commit to offering full need to the students they admit, but they may give students with higher incomes a little bit of an advantage in terms of admission. So in those cases, sometimes parents choose not to file the aid forms. That's okay if the parents are confident that they can pay that full price. But if you're not confident you can pay the full price, I recommend that you apply for aid. The other thing to keep in mind is that if you don't apply for aid in the first year at one of those colleges, you may be limited in your ability to file for aid in years 2, 3, and 4. So make sure that you feel confident that you can pay for all 4 years of college before you make a decision not to apply for aid in order to get a potentially very small advantage in the admission process. In my experience, that admission advantage is usually pretty minor, but there is some truth to that. Mention that secured debt counts. I have a business that has a significant SBA loan from the pandemic that is more than the assets of the business. Is that going to be considered as secured debt? And the answer is probably yes. To really answer the question, you'd need to look at the specific terms, but my expectation is that that debt is secured by the assets of the business and therefore would subtract from the market value of the business. But it is going to depend in the final analysis on the legal language of the loan documents. I once co-signed for my cousin, and she was not diligent in paying her debt. Will that impact me if I co-sign for my kids' loans? The answer is I don't know. The debt has now been paid in full, and so hopefully that has been reflected on your credit report. But it's really going to be a question of what's reported on your credit report as to whether it might impact your ability to co-sign for private loans. What if I have early decision on November 1st this year? Should I apply? Should I apply and submit the FAFSA right now? Well, this particular college that this questioner is asking about is NYU, and they require the CSS profile. So if your student is applying early decision, you should file the CSS profile at the same time that your student applies for admission. That way, the college can give you an estimate of the cost at the time that they notify you of your student's admission. You will not be able to file the FAFSA because of the delay that the Department of Education is having in completing the programming changes due to the new law. So that you'll have to fill in when it becomes available in late December. Is there a cap on how much the student can borrow from the FAFSA? After that, in order to pay for the academic year, the parent might need to take out a loan as well. So there is a cap. The amount that the student can borrow using the FAFSA is capped. And there are caps that apply to each year, and then also for the total that the student can borrow over the course of the 4 years of college. In most cases, that cap is $27,000 over the course of 4 years of college. It is possible for the parents to borrow beyond that. My advice to parents is not to borrow. If you do borrow, be very careful about being confident that that's not going to put you in a bad position after college. I'm very hesitant to recommend that parents borrow to pay for college. How are 529 plans considered? 529 plans are considered as an asset. Now, 529 plans are a little bit tricky because they have both an owner and a beneficiary. Whether the 529 is counted or not depends on who is the owner. Most commonly, a 529 is owned by the student's parents, and the student is a beneficiary. In that case, the 529 would be reported as an asset of the parents. A new wrinkle for the FAFSA is that if the parents also own 529s for the student's siblings, those will not be reported as assets on the FAFSA, but I expect that they will continue to be reported on the profile. If the student is the owner of a 529, there is an exception that allows that to be reported as a parent asset. And if grandparents or other parties own a 529 that the student is a beneficiary of, they're not reported as assets on the FAFSA, but they may impact eligibility if they are counted as income when the payments are made from them. And that's particularly going to be the case for profile colleges. Does the student who is able to pay a full sticker price have a higher chance than a student who needs full financial aid? In some cases, yes. The impact of that, in my opinion, is exaggerated, but in some cases, that is true. If the parents don't borrow, can the student borrow from elsewhere, a private loan, or choose a different college? Well, most private lenders are not likely to lend to a student because a student doesn't have a job, doesn't have collateral, doesn't have a credit history. So they usually require a cosigner, and in most cases, a cosigner is going to be a parent. Occasionally, colleges have their own college-funded loan programs, and those may be available to the student. A handful of states have their own state loan programs, and those may have different terms. So in those cases, you've got to do some research. My daughter is going to graduate in 2026. When should I apply for the FAFSA and the CSS profile? Probably that's going to be in the fall of 2025, at the same time that your daughter is applying to college for the fall of 2026. You have to submit the bank account statements to show the assets when completing the FAFSA, and if yes, for what month. So ordinarily, you do not have to actually submit copies of your bank statements, but you do want to have them available. The month that you want is the month that is prior to the date that you're submitting the FAFSA. And the reason that you want to have those available is because colleges often do a process called verification. And verification means that they go back and they double check the numbers on the FAFSA and or the CSS profile to confirm that they're correct. And in those cases, if you are selected for verification, and a very high portion of people are selected for verification, then you may need to have those statements available to document the information that you have provided. How accurate do you think the NPC is if the responses answering the questions are true facts? So if you enter the information on an NPC correctly, and if it has enough questions to fully assess the eligibility for aid. In my experience, they do a pretty good job within several $1,000s of the actual net price, which is pretty good when you're talking about a starting cost of $80,000 or more. You always want to make sure that you realize that those are estimates. So if you're close to the limit of your affordability, it's probably wise to have some other colleges that look more affordable, just in case the estimates are not on target. Can we apply for the CSS profile before applying for the FAFSA? The answer is yes. This year, the CSS profile is available now. It became available October 1st. And in fact, because of the delay in filing the FAFSA, if your student is applying to a profile college, and especially if they're applying early decision or early action, then you want to, you do definitely want to file the profile before the FAFSA. When completing the net price calculator, do we enter the AGI from our tax return? In most cases, yes. There are some net price calculators that don't ask for adjusted gross income. I often find that those are not as reliable. But when you use a net price calculator, they will give you instructions about how to decide which information to enter. So they'll often go into a lot of detail. They'll say, enter the adjusted gross income from line X of your tax return. Enter this amount from line Y of your tax return. So just read those and follow those instructions. So here's a question. How many months of bank statements does the FAFSA audit? Usually it's going to look at only the month prior. It's possible that they might ask for additional documentation if there is some question about the information that you've entered on either the CSS profile or the FAFSA. So you should be prepared, but usually they're only going to look at the most recent one. For CUNY and SUNY, if your income is less than 150,000, you don't need to pay. Do assets count? If you have a lot of assets, does the student still need to pay? I am not sure of the answer to that question. So your best advice there is to go to the State of New York website that governs the terms of aid for the respective colleges and asks those questions to them. Well, we're coming up on time, and I think that we've answered all of the questions from the chat. Sarah, I think that if everything is done, we're probably ready to call it a morning. I don't see any other questions, so I appreciate everyone who's listened, and appreciate your time this morning, and I wish you all the best of luck as your student goes through high school and you go through the college process.
Thank you, Bill. Thank you. Yeah, thank you for the excellent and informative presentation. Yeah. So
great. Thank you, Mia.
We appreciate it. Thank you. And thank you, Sarah, for organizing this
thank you, Mia. Thank you. Thank you, everybody.
Thank you, everybody. Thank you.
Thanks, Bill. Very
Thank
informative.
you, Annie. Thank you. Thank you, everyone. Have a great weekend. Bye.
Okay. Nice weekend. Bye.
Bye-bye.
The parents want to see the video. We have the record on the PA we are a Brooklyn Tech PA YouTube channel. All right. Okay. See you next time.
See
Okay,
you.
see you.
Bye bye.
Bye.